And in the meanwhile, I noticed some of them also have some little new experience about how to use this new app. Do they need to first download the app?
Maybe on the phone, but I think if you're on the computer, you can use the browser.
Got you. And people ask, what is the ID, the event ID?
You have a specific link, right? But the ID I can give you.
Okay. Where can I say that? On WhatsApp or in the app?
In WhatsApp.
Oh, okay.
Oh, sorry, I missed the number.
And
URL should work.
Are all of our guests automatically already muted?
All our guests are muted. Yes, they can talk.
Yeah, maybe first unmute them and we can hear them. But if they want to be muted,
that's not possible. We can't unmute them.
But if you have too many, Gabi, if you have too many people on mute or unmuted, you get a complete disaster because everybody's talking or want to talk. That doesn't function.
No,
they can just use the chat to ask questions.
Got it.
But people can let us know if they can hear us at least. They're already in.
Yes. Yes. So dear all, if you can see us and you can hear us and or just try to type something on the chat box. Yeah. If you can hear us, please type 1. Awesome, Max. Yes. Okay, but my screen is so small. Okay. Got it. So Joe says no problem. Anna also works. Sissy also works, right? Yes. How about the rest? Hello, good evening. This is Tao Li or Li Tao, right? Great, no problem. Awesome. Looks like we are, first of all, really thank you for being here on time and get yourself prepared. So, and we are about to kick off our event. And this event might be finished around 9 o'clock. So get yourself ready for tonight. And first by having a glass of water next to you and having the pen and notebook in case you want to write something down. Yeah. And let me quickly ask our speaker, Mr. André Brouwers.
Hello, Gabi.
Hello.
Evening.
Yes, nice to see you. And in the beginning of 2022, yes. What do you think? Shall we kick off our event on time?
Yeah, I'm ready for it, if you are.
Awesome. I guess everybody is ready too. Yes. Okay, and let's start. But, since I guess for most of us, this is our first time using this app, right? And how about this? Because we want to make sure everybody is able to communicate, raise your question, or unmute yourself, or put the camera on. So let's first give the beginning 5 minutes to Mr. Tom Brouwers. So maybe Tom, you can give us the quick tour about how to use this app.
Yes. Good evening, all. Yeah, it's quite an easy app to use. On the right side, in the below, you find the chat box where you can ask questions. We will see all these questions. We can mark them as questions, and we can collect them to answer them on a certain moment. It's not possible to turn on your camera or microphone, so that's turned off for everyone. People will only see your first letter and the second letter of your last name. So you you stay in private in the chat. We see full names, but the rest of the public will only see the first letters. And we will show you the presentation. We will do some screen sharing tonight, and we will ask some questions where you can interact with the system. It's really easy with your mouse or your finger. It depends on you use your computer or an iPad, for example. You can fill in these questions, and yeah, that's it for tonight.
Awesome, awesome. Okay, so I think this is a very user-friendly app. And one question, and Tom, so if people want to put the camera on, they can choose to do that, right?
No, it's not possible.
Oh, okay. Yeah, I know some
But
of the.
But I hope they are all dressed up nicely, Gabi.
They are. Yes, people were even asking me privately about the dressing codes tonight.
Yeah.
But you know,
That's good.
after the. Yeah, so I think for the situation become stable, we can even organize the offline event so we can really meet each other face to face. Yeah.
Yes.
Awesome. So first of all, thank you, Tom. Thank you. And now I'd like to really officially also kick off tonight's event. And by really welcome each of you, and I want to say Happy Chinese New Year already. 新年春节快乐，春节快乐。And so I would like to also introduce myself very briefly. And my name is Gabby Zheng. Chinese name is Zheng Xue. I come from the very beautiful city called Chengdu, China. I know most of you already know that city. Currently, I'm living in Netherlands already for 6 years, despite my Dutch, and I'm very familiar with this country. So I had been really in a journey of unemployed for 7 months. And then I got the regional office, the manager in the very big Chinese corporate. I was working there for 4 years. And then I decided to run my own company. So currently I'm an entrepreneurship. So that is a little bit about my career background. But privately, I have never been giving up about searching for the opportunities where I can learn and grow and accelerate the quality of lifestyle in Netherlands. And I do like to engage those opportunities and the expert from my network into the Chinese communities, and then we can grow together. So this is really my honor tonight to introduce our speaker to each of you. So that is a little bit more about myself. And now I'd like to, have some capture something about each of you. And so let's work, have one interaction session together. And so, Tom.
Yep.
Yes, could you help us?
Yes.
Yeah, because I really would like to say what is really the motivation for our guest to join us tonight? Why are you here tonight? And so you might already see the very short survey. Oh, some of them already start to fill it in very quick. So what are your motivation to join us tonight? Is to find out the investment opportunities in 2022 and even longer? Or is to really learn and develop your own investment strategy? Or here to find out our the 1 year the stock market trading course, and we will kick off by April 1st. So I will give you another 1 minute to fill it in. Yeah, I see the orange bar still growing. Thank you for your participation. If you have any issue about filling the survey, also feel free to leave the messages in the chat box. Beautiful. Okay. So,
yep.
Awesome. Thank you. So in the meantime, I'd like to also give you some little bit of picture about how tonight will go. So tonight we will have in total 2 sections. So section 1, our speaker, Mr. André Brouwers, will give us the overall presentation, where you will really capture about the investment market and understand how is the current environment is, and also hear his insight about the investment strategy. And the section 2 is the interactive part, where you can really ask any questions directly to our speaker. And the question can be something relevant with your own investment or something about our like a trading course. And we expect this evening will be finished around 9 o'clock. Yeah. Okay, now before we started, and I'd like to also like introduce about who is our speaker. Yeah, I'm getting quite excited about it. Yeah. So first of all, I'd like to position himself as a very trustworthy and love to give the coach, investment coach. Himself had already been giving the coach for more than 25,000 of the Dutch investors. And this is his first time using English to really share his experience with the international community and to Chinese community. Yes. And secondly, he is reading like in 2020s, and he has been reading like giving the name and ranked as the best investment expert in Netherlands, chosen by a public jury of 15,000 of investors. And himself, over the past 35 years of the experience, he is an investor, the stock trader, and hedge fund managers. So, and probably for some of you who is watching the Dutch national televisions, you might already see him because he is a 5 times winner of the largest national investors debate. And so that's all. Maybe that's even not all about who he is.
It's more than enough, Gabi. It's more than enough.
Enough. Okay. And by the way, he also likes hot pot. Yeah.
Correct.
So
Chinese food.
Okay. And at this moment, like I think I can put myself on mute because tonight, like we are here to really hear from you, learn from you. And okay, the stage is on yours, Mr. André Brouwers. Okay. Thank you.
Thank you. Thank you, Gabi, for the introduction. Thank you also, everybody who's attending this online webinar, for, of course, your time and interest. And I hope I can match up with the expectations. I prepared a presentation, and the title is, of course, Invest Now, but How? Because investing might seem easy. Sometimes it is, but actually, over the last 35 years, I found out that it's never easy, never a done deal. It's always something different that keeps the world running and also the financial markets running. So I want to give you some insights, some expertise, some knowledge, some lessons from the past. And also I want to introduce a strategy. It's a way of dealing with the markets, dealing with your own money, your wealth. And I hope I can attribute a little bit tonight for that. Okay, before we start, I have to show you a disclaimer. And since you all read Dutch and you understand Dutch, that's what Gabi told me. No, that's a joke. I have to tell you the disclaimer. Basically, you are very smart people. That's what I understood. So this webinar is meant for education purposes only. Examples of trades are meant for illustration purposes only and should not be seen as an advice to buy or sell any financial product. And if you want advice, go to a financial advisor before you do any trades or strategies or tips or whatever. So I hope you this makes common sense. All right, let me tell you a little bit. I'm going to shortly introduce a little bit myself and who we are, the traditional way of investing, the challenges nowadays, talk a little bit about our philosophy, this investment strategies. I tried to give you some real-time examples. I will switch in the meantime to the live environment where you can see the prices moving up and down, especially in New York now because Amsterdam is closed. But US is still running, of course. I will show you some results that we achieved over the years. I tell a little bit about a coaching program that Gabi and the Beleggings Institute together set up for you. We will start the 1st of April, and if you're interested, I want to tell you a little bit about it. I think it might be worthwhile, to be honest, to think about it, whether you should join this program. It's a one-year program. And basically what it comes down to is that I will teach you how to maneuver in financial markets. I will take you by the hand. I will show you my strategy. I will show you the actual trades, the actual things we do, whether it's a plus or a minus, a winner or a loser. I will share them with you. I will explain what I do. And overall, after 1 year, you should be able to build your own strategy. And I hope that one lasts for the rest of your life. So that's what I'm in. This is my business, education business. As Gabi explained already, we've been running this business now for more than 10 years as a beleggingsinstituut, which basically means investment institute in the Netherlands. Before that, I set up an academy together with the first international broker in the Netherlands, and also an internet broker in the Netherlands. In those days, what's called Alex. It became Bink, and now is currently running under the name Saxo Bank. So yeah, I think there is a lot for you to learn, to experience. What is always difficult for me talking into a camera is that I have no clue whether I am going too fast, too slow, whether it's interesting or not. So you have to give me some feedback if there's anything going on. I hope you understand that I have to go somewhere middle of the road. Okay, I cannot go too much into to left or to right, because otherwise I lose the audience. Normally, I'm in favor of a real experience face to face, but yeah, since COVID, we are currently not able to do that. So maybe at another time, once COVID is behind our back. And of course, there's room for questions and answers, as already Gabi told you. So what is it that we do? Well, basically, we do education and information for private investors in the Netherlands and also in Belgium. Currently, we have some international audience, which is you. And also I'm running a group in Dubai. So yeah, we try to expand a little bit to get new faces, new experiences also for us. My international financial markets background is, as Gabi told you, hedge fund management, asset management. I've been developing strategies since the 1990s of the last century. Yeah, so I think we can say that we have a little bit of experience in financial markets. We work together with the Dutch Telegraph newspaper. We work together with RTLZ. We found out we created an exchange game, as we call it. And yeah, every now and then we also do personal coaching programs. Next to the Investment Institute, we have Brouwers Capital Strategies. That's another corporation, and we develop strategies for international financial organizations. That can be pension funds, family offices, asset managers, and that's international. So that's a different ball game. All right, I want to start with part number 1, analysis of current conditions in financial markets. Before I do that, I want to jump back a little bit in time. 3 months ago, we had a presentation for the first time with a group. Excuse me, this is the name of trades that are running. My computer is still executing trades, and I cannot switch them off because otherwise I lose money. And I want to earn some money tonight, so the trades will sometimes make some noise. Presentation and the situation 3 months ago. And yeah, I show you a few charts where you can see for yourself what the situation is and was over the last couple of years. Now, here you see the S&P 500. The S&P 500 is an index. It's basically the 500 biggest companies in the US, listed companies in the US. And you can judge a market based on a valuation. A valuation is something like, for instance, how much money a company makes, and then how much you pay for the share or for the stock if you buy this company on the stock exchange. So we used to have something like a price earnings. So you have the price that you pay for the stock, and you have the earnings. And once you divide that in the correct way, you get an idea of what you pay once you buy a stock. Now, of course, investing is not only about stock market, but stock markets are one of the most famous one. And it's also the one that most people work with. And I myself work with them as well. Of course, for many, many years. So if you take a look on the stock market and you take a look on the last, let's say, 50, 60, 70 years since World War II, equities, US equities have generated positive returns most of the time over the longer run. Now, you have something which is called the bull market, a market that goes up, and you have something that is a bear market, is a market that goes down. Now, first question to you. It's maybe an idea. Have you any idea why a bull market is called a bull market? If you have, you may share your answer. I hope everybody is still there. I see that someone is typing. Not so sure why. Great taste. All right.
A great thing about the hot pot part. That one.
Okay. That was about the hot pot.
Not about the bull.
Okay. Yeah. Okay. All right. Anyway, I don't see any. I see some answers coming in, but most of you probably are not so sure about it. Well, let me tell you. It's pretty simple, basically. A bull is a bull likes red color. Yeah, that could be, but red color is the color of most of the time of the market going down. Green is the ox horn is up. Really good. Ox horn is up, and what an ox horn up means that if he catches a prey, he throws it into the air, and a bear is with his claw smashes it to the ground. So this is the reason why we have a bull and a bear market. And this is the symbol of the bull market in Wall Street is this the ox or the bull. So this is just a little introduction. Thank you for the answer. All right. Well, anyway, if you see this, sorry, something went wrong with this chart. But in what you can see here is the so-called Shiller PE ratio. And I showed that one 3 months ago, and I told the people, the audience at that time, that the market is quite, I would say, overvalued. Okay, and if you put the PE ratios in historical perspective, so if you judge where we are right now, I show you here a long-term average. Okay, so if you take a long-term average, what we used to pay in the stock market as far as PE is concerned, so the profits and the prices on the stock exchange, then you can see that the average would be like 15, 16, something around that number. Now, I'll let you guess where we are right now. I'll let you guess where we are right now. Well, right now we are anywhere, so in this high-end region, so quite high for now, and definitely it was not a cheap environment. And it's also a little bit maybe talking about what the situation currently is. I will tell you a little bit later as well. Now, first of all, what we had 3 months ago, that sentiment was extremely positive. Okay, you can measure that, and the sentiment was okay. What was also expanding was the central bank's balance sheets. Now, before I can tell you a little bit about the environment, you have to understand that a very, very important player in the financial markets nowadays are the central banks as a financial operator. So what they did over the last 10, 15 years, they increased their balance sheets by buying bonds. For instance, what is a bond? I don't know whether you are aware of what a bond is, but a bond is a loan that you can invest in. So if the government, for instance, needs money, they will issue a bond, and you as an investor can buy that bond. The promise then is that you will be paid at the end of 10 years, for instance, you get your money back, and in the meantime, you get an interest rate. Now, the point was that the interest rate, you are aware of that, of course, the interest rates went down all the time. 10, 15, 20 years ago, we had high interest rates. Now we have very, very low interest rates. Recently, your central bank, China, lowered the interest rates. And that is something that the central banks in Europe, in Japan, and in the United States did. Now, is that something bad? No, it's not something bad. But what they did is they increased the amount of money, and this money has to go somewhere, looking for return. Now, if you don't get any money on your bank account, if you don't get any interest being paid on your bonds because interest rates are low, then people look for an alternative. Now, why is that important? Well, simple, because a couple of months ago, the central banks were still flooding the market with more money. They were just printing money. Now, until a few weeks ago, basically, the central banks said, okay, it's all right, everything is under control. But now, you might have heard about the word inflation, and inflation is running hot. Prices are going up due to COVID, due to bottlenecks in the economy, due to all kind of incidents, not enough chips. A lot of companies have a problem and prices are rising. Whether it's commodities or something else, everything is going up, up, up. Now, if everything is going up, 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 that means that your purchasing power, your money is going down, 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 because you have to compensate your inflation. You have to compensate the loss of your purchasing power. How do you do that? Then you have to make a return. Now, if you have a certain amount of money and you lose 5, 6, 7% on inflation running hot, that means over time, if you do nothing with your money, if you do not invest, if you do not compensate the inflation rate, that means that your purchasing power will be 30%, 50% less in maybe 10 years' time from now. So this is the big problem for a lot of people. So you need to invest somewhere, somehow. Now, a lot of people did that in, for instance, real estate. Now, we all know the story about Evergrande, but if you take a look in Europe and the United States, a lot of people bought real estate. Now, that was going up, 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 like everything was going up, up, up. Now, the point is now this, that the central bank now has to take action because inflation is running hot. And if inflation is running hot, that's a big enemy for basically all of us, except for the ones who have a lot of debt. And guess who has a lot of debt? Indeed, the countries. And for instance, also these central banks, they own a lot of debt because they bought these bonds, these loans. Now, for them, it's okay. But on the other hand, they need to guard also the economy running okay. So now they told us a couple of weeks ago, they said, okay, we have to maybe raise interest rates. Now, if they have to raise interest rates, that means that an important driver of this bull market over the last 10, 15 years is suddenly changes its course. Now, if interest rates are going up, 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 that means that, for instance, bonds are going down, down, down. So the value of a bond goes down when interest rates are going up. So everybody who owns bonds has a severe problem. If interest rates are going up, that means that people need to pay more on their loans. And if you pay more on your loans, you cannot spend that on, for instance, groceries. So that might be a problem after all. And if you spend less, then probably the earnings of companies will go down. So what the market immediately understands, once somebody starts about inflation going up, they say, oh, now central banks must follow. They have to go up with their interest rates. And if that's going to be the case, then probably future earnings of companies will probably go down. Now, this is the situation where we are right now. Actually, tomorrow evening, the Central Bank of the United States, the Fed, they will make a decision on whether they're going to increase the interest rates, yes or no. Now, the market already thinks they will increase interest rates this year for probably 3 or 4 times. That's not the end of the world, but it's maybe the end of the bull market for the moment. And what we see right now currently is that the bull market is under pressure. So stock markets are going down quite heavily, and especially the big companies that were the driver when the market went up, up, up. So we had a few big companies, the well-known names like the Apple, the Google, the Facebooks, all these big companies, the Microsofts. These were the ones that were especially in favor of investors for the last couple of, let's say, years. Now, I will tell you a bit more about that. I will show you some graphs and I will explain to you what the impact might be. So as an investor, you have to be aware of the dynamics between inflation, interest rates, economy, and of course also where to put your money. So this is an important dynamic that you should understand. Now, if you talk about a possible impact of interest rates, this is a chart. Now, I already told you about PE. This is an important number. The PE is the price earnings. Okay, this is the amount of money you pay when you buy a stock. Okay, now in the Nasdaq index, there are a lot of companies with big technology. They have growth, and this is fine. However, you pay a lot. Basically, you pay a lot for a company with a growth story. If, however, interest rates are going up, this might impact the amount of money that people are willing to pay for a growth company. And it might be interesting for for instance, for companies that are called value companies. Companies that don't grow too much, but are very stable companies. And that might be more interesting to put your money into that category. I come back to that later. For now, it's important to understand that rising interest rates have a difficult impact than falling interest rates. Like that's what we had for the last 10, 15 years. Now, if you take a look on the psychological phase in a bull market, okay, you see basically something like this. You know, a market starts up, comes down a bit, then goes up, and then suddenly the public comes in and everybody gets excited about investing. And I think this is what we saw over the last 1 to 2 years. We saw that in this phase that a lot of public came into the game, okay? 10 years ago, not many people were interested to put their money on the market. Now, it looks like everyone is involved. You have this crypto, maybe mania. You have this stock exchange where everybody wants to be part of. You see the real estate running hot. So this is, to me, I wouldn't say a dangerous environment, but you have to be aware of the fact that we're definitely not here. We are more here somewhere. And that means that you run the risk that the market could fall. Now, again, then you have a problem, because on the one hand, if you don't do anything with your money, you lose purchasing power. And if you don't do anything for the next 5 to 10 years, I will definitely tell you, you will lose 30 to 50% of your money. That's a big, big risk. Now, on the other hand, if you do get involved in the stock market, you run another risk, basically, that you now invest and suddenly your investments go down. So this is not an easy environment right now. As long as you are aware of that and you understand where we are, that's okay, okay? And we can guide you through these markets, and there's still money to be made. And sometimes even a lot of money to be made. I will tell you later on how we could do that. Now, to give you some examples of this, was a famous year. 1929 was a year when the markets went up, 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 and suddenly we had a crash, and the markets went down in a brutally way, okay? It went down about 80, even sometimes at the end of the 1933, it was down almost 90%. So that was a severe drop. In 2000, we all remember the internet hype, and we saw prices going up like crazy, and then they corrected themselves for something like 50, 60%. Now, this was in October last year. It looked like this, and I already told the people that I don't have a crystal ball where I can tell you the future, but what I do know is where we are in this cycle, okay? So I was aware of the fact that it could be a dangerous environment. Now, how did I judge at that moment the situation? Well, first of all, making a return was never easy, and it looks right now as if it is an easy job. I myself never find it an easy job to make returns, but over the last 10 years, everybody could do it. Why? If you buy something, the market took off and you make money. So it was like, hey, look, I'm a hero because I made some money in the stock exchange. But was that because of the bull market, or was that because of your brains? Okay, I know the answer. I hope you understand what I'm trying to say here. Now, you see the public coming in, and the public, again, is most of the time comes late to the party. Now, it looks as if everybody is suddenly a pro, okay? That's not the case. Certain pockets of the market are definitely overvalued, and certain pockets are definitely undervalued. So again, there's still money to be made, but you need to know where to look for it and how to do it, how to approach it. An important driver, central banks, is preparing for a U-turn, so that has an impact, okay? And they get a bit squeezed now because, inflation is running hot. They need to take action. They don't want to do too much because, everybody wants to have the party going on, but suddenly they disturb the party. So now inflation is something temporarily. That was what Mr. Powell, the chairman of the Fed, told us a couple of months ago. And I was definitely telling my audience, which I'm speaking to each week in my update, I told them, I don't believe this story about temporary. I don't think this is something temporary. I think it's here. It will run hotter, and it will be a problem. And for now, I think I get it right for now. And the central bank had to tell us, yes, we probably have a problem now. So Mr. Buffett, you're probably aware of him, one of the biggest investors of all time. He said something very interesting. People start being interested in something because it's going up, okay? Not because they understand it or anything else. But the guy next door, who they know is dumber than they are, is getting rich and they aren't. And their spouse is saying, can't you figure it out too? It's so contagious, he says. So that's a permanent part of the system. And that's really this cycle that's going on of emotions in the financial markets. And so you have to be aware of how you respond. Your psychological state of mind is very important to be successful as an investor. Now, most of the time people get enthusiastic at the end of the game. Again, this is what I already saw a year ago. Okay, and a lot of stocks a year ago, they formed the top. That was really the top of the market already a year ago. So huge pockets of the market already went down for the last 12 months, basically. And a few of them, the bigger names, are now currently forming a top and going down. We will zoom in that on a little bit later. Okay, so the situation today, I would say, okay, it could be that like in 1989 in the Nikkei in Japan index, we saw this tremendous move up and then it collapsed. And now this level, 40,000 in the Nikkei index in Japan, is the highest level ever. So still after, what's it now? It's now about 32, 33 years now. We're still not back to this level, okay? Now, I told you already about 1929. We saw the Nasdaq index in 2000. And now we see the S&P in 500. So there is definitely something to be aware of. I already told you that a small selection of stocks drove the market higher. And this tells you also that the market is vulnerable. Because if it's only a few amount of companies that are okay, then what's happening with the rest? Now, we see that now that the rest more or less is underperforming. And if you take a look on the valuation, and this is a complex chart, but it's only here to make an impression on you, to be honest. So this one here is a complex chart. So what it tells you is that the price revenue ratios of the S&P 500, this is the most important index again in the United States. If you take a look on this index, basically everything, if you take a look on where the blue line is, even the cheap stocks, so to say, are still expensive. Okay, they're still on all-time highs. So basically every sector is too expensive compared to its own history. So this tells me something, that we need to take care of this environment and take care of our money and not go blindfolded and go all in and then think that investing is a nice thing to do now. You have to use your brain, okay? Basically always, but definitely in this environment. So every sector nowadays is, compared to its own history, is expensive. It's not cheap, okay? Now, there's one good thing about this market, that the equity market goes up. Even if you express it in terms of the GDP of the United States, it's still a high value. But the next chart is a very important one, because we see also record high profits. So markets are going up, stocks are going up, that's fine. But thank God, US corporate profits are at a record high as well. So that means, although the valuation is high, the growth story is still there. So companies are still making money. And if there is inflation, then you will definitely have companies that are able to put the price pressure to their clients, okay, to pass it on. And if that's happening, that's okay, because then the profits of these companies will still be fine. If that stops, and if interest rates are going up and corporate profits are going down, then you better hide for the hills, okay? You run for the hills and you better hide. Now, as I tell you, record high profits is still okay. So far, so good. There's no big panic. There is a little bit of panic right now in the markets because we love this growth story. We love this bull market, but suddenly the interest rates are going up because of inflation. And that's a little bit of a game changer. Now, how long this lasts, how big the fall will go, nobody knows, okay? So I cannot predict. I'm not a guy who can predict. And although I have a lot of experience, I know one thing for sure. You never know what's going to happen next, okay? You will be always insecure. You never know for sure what's going to be next. All I'm telling you here is that the dynamics right now, there are certain dynamics, and you have to be aware of these dynamics if you want to invest. Now, I can show you more of this, but I think for now this is fine. And again, the Fed liquidity is the key driver. Okay, this was the key driver of this return for the last 10, 12 years. Yeah, where did this money go? This is an interesting one. If you take a look, you can see here the blue line is US equities. Now, funny enough, you can see that new money, cumulative mutual fund and ETF flows, as it is called. Now, I have to explain you a bit about an ETF because this is a big story. If you want to invest and you say, yeah, I have no clue what to buy. Can I buy a company Microsoft or Apple, Andre? What should I buy? Or Unilever or Royal Dutch Shell or Philips or maybe Baidu or Alibaba? I think you should buy Alibaba and Baidu, by the way. I will show you later why. But if you say, okay, I can only spend a little bit, but I would like to have some diversification. Now, what you can do is there is an instrument which is called Exchange Traded Fund. It's an ETF. And an ETF is basically a basket of stocks. So if you want to own the 500 biggest shares in the United States of America, you need a lot of money. But basically, if you buy the ETF based on the index in the United States of America, which is the S&P 500, then you only need maybe $100 and you can buy already basically 500 tiny little pieces of all these stocks. And then you buy one stock and you have the diversification of 500 stocks. That's a great instrument. And that's a very popular one. And a lot of money over the last 10 years went into ETFs. It's a big story. Okay. And it's a great instrument for somebody who wants to invest and want to have his diversification. Now, it's not a miracle. It's just a way of investing. If you buy this instrument, a way of finding diversification. Instead of buying 500 companies, you only buy one, and then which is the ETF, the index, and then you have this great diversification in your portfolio. Now, these ETF flows, they went up. This was an incredible story. A lot of money went in there, but be aware of the fact that an ETF is nothing more and nothing less than just the index. So if the index is going up, your ETF will go up. If the index is going down, your ETF will go down. Okay, so this is basically what it does. There's no miracle behind it. All right, okay, we zoom in something else, which is a remark of one of the famous economists in the last century, which was John Maynard Keynes. You might have heard of him, but what he said is a very interesting remark, which he says markets can remain longer irrational than you can remain solvent. So the point is, yes, the market is overvalued. Yes, the market is expensive, but it can stay overvalued. It can stay irrational for much longer than you think. Okay, so whether you make a brilliant analysis, that's fine, but in the end, it's about making money. Okay, so and making money makes is a different game to play than just making a nice analysis. Okay, all right. This was my little introduction. Okay. Yes, Young says even negative interest rates in some Dutch bank. Yes, that's for sure. That's a big problem now, because the interest rates on the capital markets is negative, and that means that the banks, they need to pay to the central bank when they put their money there, and that means that they want to pass on this problem to you as a customer. So this means that if you have money in your bank account, they will, at a certain amount, they will charge you negative interest rates. So you have not even a return on your money. You will lose on your money. You will lose on the purchasing power due to inflation, and you probably lose a little bit because of Dutch tax. So this is not a great funny story and not a great situation to be in, but this is actual reality. So my question for you is now, what is your strategy? Are you currently involved in financial markets? In what way? Do you maybe have the ETFs? Do you invest in real estate? Do you invest in stocks? Maybe you have some bonds. Maybe you have a mix. Maybe you have gold, maybe Bitcoin, whatever you can have. It's all fine. Okay, some people say, I buy some stocks. That's great. And of course, it's about thinking about what it is. What is your strategy? I mean, you can buy some stocks and it's great if they go up, but what is it that you do when they go down? Okay, sit it all out, wait until the market comes back. That to me, that's fine, but at least you have to find out the answer before you invest. Okay, I want you to have a very simple answer. I always say to people, if you invest, tell me what you will do if the stock is going down. So what is it that you do if the markets are going down? And a lot of people then look at me and say, yeah, but stock markets, they will go up over time, isn't it? Yes, they did in history, in the past. But sometimes, like in Japan, you might need maybe, I don't know, maybe 10 years, 20 years, 30 years to wait before the portfolio is back up again. And so there you have to ask yourself this question: how do I approach? So investing is not about buying something. It's about thinking, what is my goal? What is my strategy? When do I get in? Why do I get in? When is it that I go out? Okay. Can I protect my investment? So I will tell you a little bit on how I do this and what my strategy is. So I want to approach this. But before I do that, I share a few lessons from the past. Okay. Now, this chart is a very important one. If you take a look at this one, it tells you the amount of return, what you would have made year over year when you invested for the last 200 years, because this chart starts in 1800. So if you, for the last 200 years, would have invested in stocks in the United States of America, your annual real return, so after deducting inflation, was 6.6%. So that might or might not be very shocking to you, 6.6%, but that's the average. Okay. Now, if you invested in bonds, which is again these loans, right, you would have made half of it. Bills, these are shorter term bonds or deposits on your money, or gold. But one thing I hope these people would never have done, which is a negative year-on-year result when you put your dollar in cash reserve. So if you put your dollar in cash, you lost a lot of purchasing power over the years. And basically $1 is worth 0.05 cents after 200 years. So there's nothing left of your purchasing power if you don't invest. Now, the great story is, if you would have invested in stocks, you would have made the best return. Even even real estate is somewhere here in the middle. Okay. So the best place to go is stocks. This is what a lot of people know. However, I want you to zoom in and to understand the next chart. Take a look at this one. What you here now see is one of the biggest asset managers in the Netherlands, basically in Europe, is called Robeco. And it's not about Robeco. Here could have been any name, any bank name could be here. But Robeco runs a fund that invests worldwide. Okay, so they have a diversification of about 115 blue chips company. Now, blue chips is the name for the big companies, the really strong ones. Now, blue chips, by the way, anybody knows where it comes from? I know Chinese people don't like to go to the casino, but the blue chips in the casino, this is where this name comes from. The blue chip is the one that is the most important chip in the casino. So the worldwide stock market is about the blue chips, as they are called. So it's a big portfolio of the big names. Now, what you can see here is even these great guys, these clever guys from Robeco, asset managers, in the year 2000, when the market was going up forever, and then it suddenly went down, and they lost, you can see that here, in their portfolio, 62%. So they had a great portfolio, blue chips, the best companies. They had a great diversification. Everything was okay. They had handpicked these companies. And even with this knowledge, they lost 62% of their portfolio. That happened once. And in 2007, 2008, 2009, it happens twice because of this loss of 58%. Now, I want you to understand that the average return over the last 20 years might have been 6.9%. But the last 15 years, your average return would have been negative 2.1%. So basically, what this chart is telling you, that if you want to protect yourself, and if you, for instance, would invest now, and we would have something like this going down for 30, 40, 50, 60% or something like that, it might take 10, 15 years to come back. So I am not in this game. I don't like this way of investing, okay? And I found out, even if you take a look on this chart, that if you run your money with 8%, 8%, 8%, 8% every year, and you do that for the next 30 years, you make 8%. 100K will be 1 million in 30 years. If you manage to go by 8% a year, okay? Now, if once every 10 years you will have a drop of minus 30%, the gray line will be yours. So you go up for 9 years, you go down 30%. You go up for 9 years, you go down 30%. Now, if that happens only 3 times in 30 years, you will exit the game with 250K. So 100 will be 250K, or 100 will be 1 million. Now, what I try to show you here is that it's very important to do one thing, okay? Which is never lose money, okay? Rule number 1, never lose money. And rule number 2 is never forget rule number 1. And this is the message of, again, one of the big investors. Now, I can hear you say, yeah, that's an easy one. How can I make sure that I never lose money? Well, of course you will, every now and then, will have a drawdown. You will have a setback. That's normal. Everybody will experience that. There's nothing new to that. But what I mean here is that you have to be aware of the fact that if you lose, it is very hard to make up again. So if you lose, for instance, 20%, you need to make 25% to come back to break even. If you lose 40%, you need 67% to come back to break even. So if you lose 50%, you need 100%. If you lose 60%, you need 150%. That's almost mission impossible. So the point is, try to avoid these big drawdowns, okay? So what I learned over the years is whether you have smart people running portfolios, whether you have a great diversification, whether you have the best portfolio, in the end, it doesn't guard you for a drop in the markets, okay? So you have to change your strategy. That's what I did. I changed my strategy, and I will always protect every euro, every dollar I invest, I will protect. How? I will buy insurance, and I will explain you in a very simple way a little bit later. Now, this to me is very important. And to show what I'm talking about is diversification. And a lot of people, a lot of asset managers, a lot of people with the banks, they have a strategy like the Robeco ones. Okay, they buy good companies, they go for the long run, and the bull market took it from here for the last 10 years, and everybody is a hero. But I know this was because of the bull market, not because of the brains. And a lot of people will find out the hard way in the next couple of years, I am afraid, because once markets are going down, they say, hey, why my investment manager doesn't sell because he sees that the market's going down? Why is he not hedging my portfolio? Why is he not doing this or that or so or such? I know all of that. I've seen that before. I've lived through these charts for the last 35 years. So I know what the mentality will be. I know what the strategy of these banks and brokers and asset managers will be. And there's nothing wrong with that. It just has certain consequences. And what I'm trying to say here to you is whether you have diversification or not, once markets go down, basically everything goes down. Whether it's real estate, emerging markets, large caps, small caps, big companies, small companies, real estate, trusts, whatever, they all went down together. Now, there is a difference between 200 years and 20 years. And guess what? I will not live for another 200 years. That's pretty sure. I might live for another 20 years. And once you have reached a certain number in your life, and I hope you're all young and still have a lot of time to go. But even if you're young, you don't have 200 years. You have time frames like 20, 30 years. And in this period, you have to build your wealth. And if in these 30 years, something like a drop comes by, you have a little problem. So I want you to teach a strategy, a method where you can avoid these big drops, okay? And of course, it's not overly complex. It's no rocket science, but it's not simple that I can explain to you in let's say in an hour time, okay? So I do my best. I want to show you why I use a different strategy. I want to explain a little bit about it, so you have an idea of what we do and why we do it, okay? But if you have shorter time frames, you are more vulnerable, okay? Longer term, equity investments are attractive, that's for sure. The traditional approach, by the way, which is the diversification, sit and wait, is vulnerable, okay? Diversification is logical, definitely it's logical, but not enough to protect if you need it to protect your money. Stable returns need a different strategy. This is what I found out over the years. And this is why I set up my own strategy system. This is something I want to teach people so that they can profit from it as well. Now, a few things I learned over the years. No matter if I have 35 years of experience, I know basically that I don't know. This is a great important thing to understand. I know that I don't know anything, okay? Because anything can happen. Whether it's a virus, whether it's a terrorist, whether it's a bookkeeper, whether it's a fraud, whether it's a whatever scam, whatever comes by, you have a lot of things that can happen to your money, okay? Now, if you look into the future, you will never know what will be next. You can have an idea, you can have a vision and an idea about it, but you will never know for sure. If you want to read a great book, it's called The Black Swan. The Black Swan is written by Nicholas Taleb. He's a professor, ex-option trader on the Chicago Mercantile Exchange. So he has a background like I have, but he is a great genius mind. And he wrote a book called The Black Swan. And I can definitely advise you to read this book. And what he tells in this book is that we forget about these what you call the fat tails, okay, the outside, the probability of something nasty happens, and what the impact of an event like this is going to happen. So it's going to happen to your what's going to happen to your money or your wealth. So we as human beings always think that something will be logical and natural. So we think the outcome will be something here, but might be a little chance, but something that happens over here, like for instance this virus, it caught us all, like the terrorist attacks, like the frauds or the scams, or suddenly something happens in the world. Maybe now Russia is going to Ukraine, and maybe another impact is coming. We all don't know that, okay? But basically I understand that I don't know nothing. And what I also understand, that even the stupid things that you think that cannot be true, it can be true. So everything is possible. Now, if you understand that everything is possible and you don't know anything, what does that mean for your strategy? So the only thing I could think of is, okay, I can only do one thing. I cannot tell what the market will do and whether I make a certain return in the future. What I can handle myself is not the return. What I can handle myself is the risk. So I have to focus on risk. If I manage my risk well, the return will take care of itself. That's basically my message, okay? So the focus should not be on return. The mindset should be, what is it when I'm wrong? What will it cost me when I'm wrong? And what can I do to protect myself when I'm wrong, okay? So what I do is I focus on continuous risk management, but I also focus on trends, because I need return. So I need to jump into a trend, get out on time, and try to avoid a downturn, or even better, try to trade the downturn and maybe make some money on the downturn as well. Easier said than done, okay? But if I don't focus on something like this, it will never happen. So what I will do is I try to translate market movements, trends, into a return for my money. But what I used to do with every investment I do, I calculate my risk return ratio, okay? And I'm looking for a special scenario, okay? I also want to wait for a certain opportunity. And the opportunities I try to profit from is something that I'm in a defensive way. I try to make money for the next 3, 6, 12 months, okay? So nothing for the real long term. My focus is on the next couple of months, okay? I want to make money each year, like the 8% each year. That's my mission, okay? How can I make 8% each year without a lot of risk, without losing 30, 40, 50, 60%? That's the focus that I have, okay? So this is what I'm trying to do, taking care of risk, and hopefully the reward will come. Now, I will show you something. If I talk about a simulation, a scenario, this is a way I think and I can manage my money. Now, to give you an idea, this is a chart that tells you something about a position I have in Royal Dutch. Royal Dutch is of course, you all know that, Shell. You might be the petrol stations, etc. You might be aware of that company. Now, if I'm an investor, the traditional way, I buy a stock, and the blue line tells you what the stock, in Dutch it's called an aandeel, okay? What happens if the stock is going up I make return 5%, 10%, 50%, 20%, etc. What happens if it's going down? -5, -10, -15. And I always say a stock is like a rocket. It goes up like a rocket, but it also goes down like a rocket. Okay? I don't want to sit in a rocket if the market goes down. Okay? I want to be in a rocket if we go up, but I don't want to be in a rocket if the market goes down. Now, what you can do is you can buy protection, like a fire insurance on your house. If you buy a house, you buy a fire insurance. Why? You never know if and how and when your house is maybe will catch fire. Okay, you have no idea, but you want to protect yourself, so you buy a continuous protection in the form of a insurance. Now, this insurance is not for free. You have to pay money for this one. But the great thing about the insurance is that if your house is catching fire and losing value, a certain amount of own risk is there, but the rest of the risk you exchange that to the insurance company. You mitigated that risk. Okay. Now, the mitigation of risk is something you can do in the stock exchange. So you can buy a stock, you can buy an insurance, a protection of the stock going down, and this is not for free. It will cost you money, but at least you know for sure the first amount of risk I take for myself. Okay, fine. And if it's going more down, I will definitely lose a little bit more, but not like dropping like a bomb, okay, or like a rocket. So I can choose my own strategy. And this profile tells me this is my strategy. This is my simulator. If you go up, I will go up. Not as fast as a rocket as the stock market, but I will be a bit slower, but I will still go up. But if we're going down, I won't fall down as the stock will do. I will manage my money and I will protect my investment. Now, this is my whole philosophy. Now, I want to explain to you how is it that you can do something like this, André. This is what I have to teach you. I'm willing to teach you. You can be part of the program. It's all up to you. Now, I show you a few components tonight, okay? So you have a clue of what we're doing here. Basically, what I tell you and will teach you is two things. I will tell you about a 80% defensive strategy. It's about wealth control. It's about the 8%, making 8% return a year. Actively managed portfolio of stocks. I'm looking for medium-term returns, okay? And I will structure my money with a hard protection. It's a philosophy on the 80% of your money. So if you come in and you have 100,000 to spend, or 1 million to spend, or 10 million, I don't know, whatever the amount is, doesn't matter. What is important is if you have 100,000, for instance, take 80% and put your money and go for the 8% year on year on year on year. If we achieve that one, that is great, okay? But protect your money. Now, on the other hand, there's a nice game to play in the markets. You can trade. You can, if you like that, if you like to be involved in trading, you can make more money. You can make more returns. You can maybe make 20, 30, 40%. I don't know what. Hopefully structural. But don't lose your shirt here, okay? But on the other hand, we will focus on trading. So how to trade, looking for high potential, trying to have small risk and high leverage on your money. That's something I like also because I've been a stock market trader and I like trading very much. But I know that over the years, if you have more money to protect, it's more important to focus on the 80% than on the 20%. However, in our program that we will do for the next year, I will combine the two and make sure trading is something completely different than investments. So investing is something completely different, has a different mindset, has a different attitude you need to have as an investor than as a trader. Okay, I will teach you both, and I will focus in first instance, of course, on the defensive one. And once we have that under control, we go for the offensive mode. Okay. Now, if we talk about trading, investing, it's basically about the 3 M's. We call that I need to teach you a certain method. I need to teach you certain money management, and I need to teach you the right mindset. The 3 M's is basically the core behind our approach. Okay. If I show you this parachute, it means that the parachute is what I just showed you in this example here. The red line is where I put my money. The parachute is this. This is my parachute. It goes down, fine, but I'm on a parachute. I go down as well, but not as much. Okay. If I go up, I will not go as quick as my neighbor. That's fine. Good for him. But if I make my 5, 10, 15%, I'm more than happy. Okay. So it's a different mindset, a different approach. Now, I told you already that you can insure yourself against fire. Okay. And an instrument that we use is options. Okay. Now, options, you might or might not have heard about it. I will, by the way, I see a question coming in, 80-20, not 50-50. I will address this question. It's a good question, Dan. Thank you for this question. And Zheng as well. And I will answer some questions that are coming in, but I want to finish my story and then I take these questions, okay? So the options here that I use are the best way to hedge myself, okay? So I need them to protect a company. So I want to show you just a simple little thing so that you hopefully understand what I'm talking about. Now, for instance, let's take a look at this one. Now, suppose you are interested in buying a stock. Now, I'm interested to buy, for instance, Ahold. Ahold, you probably all know, it's like Albert Heijn, it's like Bol.com. This is the company, and it's listed in the Amsterdam Stock Exchange. Now, the stock is currently at 28. Now, let's suppose that I'm interested right now to buy it. Okay, to be honest, I wait a little bit more, but I'm interested to buy it around 27, 27 and a half. This is what I'm currently looking for. Okay, now why? Because I believe that in the next 3, 6, 9 months, this stock will probably go up anywhere in the range 32, 35. Okay, this is my expectation. Now, I want to make money based on going from 28 to 32. That's 10, 15% if I buy the stock, but I don't want to be a stock owner. I want to be stock owner plus protection in a clever way. Okay. Now, if I buy this stock and you say, oh, great company, buy the stock because Bol.com will go to the exchange and a lot of analysts are positive about it. I all hear these stories. Fine. But still, the question is, what is it when the stock is not going the way I want it? So how do I protect myself? You can buy an insurance and it's called a put option. Okay. A put option. Put it over there. It means that you can put your stocks in the hands of somebody else. So you buy the right to sell your stock at a certain level. For instance, 26. And you want to have this right for 1 year. Now, so you buy a stock at 28. You buy an insurance at 26. You have this insurance for 1 year. And whatever happens to the stock, whatever happens to the company, whether they go bankrupt or not in this year, you are protected. You will always get 26 euro a share. And since you bought it at 28, your risk per share is 2 euro. Okay. However, I can tell you that the premium you have to pay to protect these shares for 1 year is actually this afternoon, it was at 1.75 a share. So you pay 1.75 for a 1 year protection on your stock. Now you have to remember, if you have 100 stocks, you need 1 put, okay? Because each put is about 100 shares. So if you buy 100 shares, you need 1 put to protect. Now let's say we would do that. So you buy at 28, you have a strike price of protection at 26, that's your insurance. So you your risk is 2 euros a share, okay? Now, there's one good news that as a shareholder, you will receive dividend, okay? The company makes money, and who belongs this money to, this profit, is of course for the shareholders. So a large part of the profits are being paid to the shareholders, which in this case is around 1 euro a share. So around 1 euro, this is the expectation for the next year, for the coming year. Now, if I pay 1.75 for the protection, but if I get 1 euro per share, that means my protection is only 75 cents. Okay, so I say, okay, this 1 euro I use for paying this 1.75. So my protection now costs 75 cents. Now what happens now? I get a risk of 2 plus the 75 cents, which is 2.75. This is the maximum that I can lose for the next year in this investment. So I buy at 28, my protection is at 26, gives me 2 euros risk.
Order filled.
I need to pay 175, but I will receive €1 in dividends. So that means, in this case, that my risk is only 75 cents. So at 25.25 is basically where my actual protection is. So I buy at 28, 25.25 is my protection. I can always sell at 26, but I paid a premium of 75 cents. Now, the good news now is, if I'm right, and the market goes to 32 in the next coming months, that would mean that 28.32 means a €4 return, €4. However, I paid 175 for my insurance, so I only have 2.25, okay, as a profit. But I also receive 1 for, in this case, dividends. So I have 3.25 upside. Now, if I make 3.25 on this investment, and the actual investment is a little less than 30, 28 plus 175 is 29.75 is my investment. And if I make 3.25, that's more than 10%. Now, if I make 10% in the next 6 to 9 months, I thank you very much. I bow. I drink a nice cup of Chinese jasmine tea, or even better, French wine. And then I say, okay, thank you very much. Up to the next deal. Okay. So I see this as a deal, and I want to make some profit on this. But I'm always protected. So can I be wrong? Yes, of course. The market can go down. The stock could go back to 22, where it was a year ago. Is that possible? Rule number 1, everything is possible. And I don't know. So yes, that's possible. It's not my expectations. It's not where I put my money, because I believe that there is some upside here, and I want to be involved. Okay. Now, this is really the basic idea about it. My strategy, to be honest, is a bit more complicated than this. Okay. Because now I'm going to do something completely different with you, and something, how you say that, dangerous with you. Nothing happens, but I'm going to do something dangerous, because I'm going to explain to you that I never buy this stock. And you say, yeah, come on, you tell me buy the stock and buy the insurance, and now you're going to tell me leave the stock alone and buy something else. Now, what I do, instead of buying a stock, I buy a call option instead. Now, what I want to do is to show you what kind of call option I would buy. Now, again, this is a bit dangerous for me, because I might lose you now in this story. Okay, it's a bit complicated, but I try to do my best to explain to you. Okay, now I have to show you this overview. We just talked about a put option. Now, a put option, if I buy a put option, it gives me the right to sell my stock. This is what we just did. Okay, we had the share, we had the stock, 28. We bought a put at 26, so I have the right to sell at 26. This was the put option. But if I have the right to sell, of course, my counterpart is somebody who has the obligation to buy. This is my opponent. Okay, I pay the premium, my opponent receives the premium. This is how it works. Now, forget this part, okay? Put this aside for a moment. We just tackled this one. We were talking about buying a put. Now I tell you, I am interested to buy a call. Now, calling is shouting, is asking for something. You want to have the right to call, the right to buy, to call your stocks if you want to. Again, I'm not interested in buying these stocks, because I believe, and I can show you, that it's far, far, far better to buy a long-term call option instead of the stock. Instead of buying 100 stocks, I buy one call, okay? And I buy it with a longer term expiration. So I buy it for a couple of years. So I buy a right that lasts for a couple of years. Now I will show you the amount that you need to pay this afternoon. And for instance, there's the longest running call option in the market this afternoon was December 2026. Now you think, okay, December 2026. What is it that you want, Andre? What I want to do is to show you that the premium in the market this afternoon was anything around €9 to pay for a call 20. Call 20. If I buy a call with an exercise of 20, and the market is at 28. I hope you understand that the intrinsic value of my right is 8, because I can buy at 20, but the market is already at 28. Now, if I ask somebody, are you willing to give me this right? My opponent will say, hey, listen, I'm not stupid. If you want to have the right to buy at 20 and the market is already at 28, then this right is already 8 euros intrinsic value. So at least you have to pay me 8 euros. I hope you understand that. But I want to have this right for the next couple of years. So until the end of 2026. So it's a long-term option. I have to pay a premium. So my opponent will ask a premium for this. And actually, the price I had to pay was around 9 euro. So basically, I pay 1 euro extra for the right to wait to think about exercising my option for the next couple of 4 or 5 years. Okay, so I have the right to buy at 20. It's already worth 8, so I pay him the 8, but actually I pay him a premium for this the right that I have it for 4 or 5 more years. Now, stick with me. We do one little exercise. What would happen if the stock would go to 0 next year? Coming years, coming months, there's a big fraud. Stock market is going down. Ahold is going bankrupt. The stock is worth 0. What happens if I would have bought my stock? Well, the stock was at 28 when I bought it, and when it's go to 0, I lose 28. I hope you're with me. If I, instead of buying 100 shares, I buy one call, I buy the call 20 for 9 euros, what can happen? But basically what can happen is that I lose my option because the stock is not existing anymore. My option has no value anymore. So I lose my 9 euro. Okay, I lose 9 euro. That's the worst thing that can happen. I won't exercise my right. I will not buy at 20, okay, because the stock is at 0, but I lose my premium. I lose my 9 euros, okay, and I will lose them in the next 5 years, okay. So this is the worst thing that can happen to me, is that I lose my intrinsic value for the next 5 years, and I have time. I have time to exercise my right. But instead of losing 28, running the risk of losing 28, I now have the risk of losing 9. Now, what sounds better to you? Losing 9 or losing 28? I hope you're with me. Okay. Now, what happens if the stock is going up from 28 to 56 in 5 years? So incredible run. The stock owner will say, that's great. I have 28, I bought at 28, now it's at 56, I made 100%. My investment doubled. Correct? And in the meantime, don't forget that, in the meantime, he will receive probably a euro dividend. I, as an option holder, as a call option owner, I have the right to buy the stock. I have not the obligation to buy. I have the right to exercise mine. Will I exercise my right if the market is at 56? For sure. Why? I have the right to buy at 20. If the market is at 56, this right is 36 euros intrinsic value. So that's a good deal. I bought it at 9 and I can sell it at 36. That sounds interesting. That means a 27 euro profit. What did my colleague did? He bought 28 the stock and sold it at 56. He made 28. What did I do? I made 27. Okay? It's not a fair comparison. Why not? He makes 28 plus, in 4 years' time, probably also 4 times a euro on dividend. So, okay, he makes 28 plus 4 is like 32. So I have Mr. 1, which is in this case 28 plus 4 dividend. It's 32. And Mr. B, this is Mr. Brouwers, this is me. I made 27. Now, I already told you, it's a rocket. If you own the shares and they go up, 28 is your profit. If they go down, 28 is your risk. What I did, I changed my game and I say, if I go down, I lose 9. If I go up, I made 27. Okay, I hope you understand what I'm doing here. This might sound too good to be true. Okay, and you know what they say. If it sounds too good to be true, there must be something. some in it. Okay. But if you understand what I'm trying to do here now my next step is the following. Okay, I told you it's a bit risky what I'm trying to do here because I don't see your eyes. I have no clue whether you're with me or not, but I continue. Okay. So instead of buying a stock at 28, I do the following. I buy one call. So instead of 100 shares, I buy one call. One call is the equivalent of 100 shares. Okay. If I buy one call for €9, it's times 100, which is €900. So I have to pay €900 premium to have this right. And I can stick to this right for the next 5 years until the end of December 2026. Okay, this is my right. This is what I just bought. The good news is if I go down, I cannot lose more than 9. Now, if I go down, not to 0, but maybe to 22, what will happen? Now, 28, 22, the stock owner will lose 6. But I can tell you that I won't lose 6. I will lose probably something like 3, only half of it. Why? Because I have bought a parachute and the call option will still be there this year because it will run until the end of 2026. So this option will still have a premium. Okay, and you can see that because if you look at, for instance, the premium that you now today had to pay for an option based on 40, for instance, the stock was at 28. You can see the stock price here this afternoon. If you take a look on a call 40, it was still 140. So that means even if it's €12 away, it still has a premium. Why? Because it's still not December 2026. So what will happen is if the market drops over the next 3, 6, 9 months, I will drop with my investment, but I will have a parachute because I cannot lose more than 9, and I will not lose 9 because I will have my right until December 2026. So we'll probably, instead of losing 9, I will probably lose, instead of losing 6, I will probably lose only 3. So I cut my risk in half by buying this call. This is the smart way. If you understand this concept, you will never buy stocks again. Okay, I tell you. So I buy this call, and this is my parachute. Now, I already told you that if you buy the stocks, you buy a put, this fire insurance, you remember? If the stock is going down, I bought my put to protect my value. And I told you below 26, it will increase value, the put option. Now, the stupid thing that I do, you might find it stupid, is I buy one call, but I also buy one put. Now it's getting complex. For sure, I will lose you now. Okay, cannot be that you understand this concept in 10 minutes. I mean, I admire Chinese and the intellect, but if you're still with me, that's great. Okay, if you lost me, don't worry. We need to go over this a couple of times before you really understand. Still with you then. Okay, Vivian, still with me. Very good. How can I buy a call? I will show you later. So much to teach you. There's a lot going on. Always with you. Very good. So we have these smart people, like Gabby told me. That's fine. Okay, here we go. Now try to understand what we're doing. So I have my call. This is my parachute. If the market goes down, my call will go down. Of course, it will lose value, but it will be sticky. But there will still be premium because I have the right for the next couple of years. That's fine. On the other hand, I bought a put. Now, if the stock is going down, I told you the put will insure you and will go up in value. Your fire insurance is worth something if your house burns down and you have the premium, this certificate of the fire insurance. This is worth money. Once the stock goes down, the put option will increase in value. Now, what will happen is, and this is really great concept. If the stock is going down, your parachute will protect yourself, but you still lose money. Okay, you will not make money, you will lose money, but not as much as the stock owner. On the other hand, if I buy a put for 1.75 for the next year, if something in the next 3, 6, 9 months happens and the stock goes down, my put option will increase. Now, hopefully you understand that it could happen that if in the next 6 months the stock would go down from 28 to 0, just try to think about that. Disaster. I will lose 9 because it's end of the story. The company does not exist anymore. I will lose 9. I cannot lose more than my call option. I lose 9. But the put option, I have the right to sell at 26. If the stock is at 0, what is the put option worth? I can sell at 26 and it's at 0. This means the put option is worth 26. I only paid 1.75. That means I make a killing. 24.25 is my profit in my put. So the put overcompensates what I lose in my call. Got me? I lose 9, but I make 24.25. That's crazy. Now the stock owner, he lost 28. His complete investment is gone. What happens with me is I lose in my call, I will make a little bit in my put, I lose in my call, I make more in my put, I lose more in my call, I make even more in my put. So what happens is at a certain moment when the stock is dropping, I overcompensate. So I first lose money, then I will compensate more, then I don't lose anymore. And if the stock drops further, what I will do, I will overcompensate. Okay? Now, if you catch this, I'm more than happy now, because I managed to give you an idea of what we're going to do with regards to my strategy. Again, it's not rocket science, but if you hear this in first instance, it might sound different and difficult. Now, different is definitely, but difficult must be. Okay, it's not an easy one. But I hope to give you a bit of a taste of what I'm trying to do. Okay, this is not a complete story because there is more to it. And how do you select the call? Where can I buy it, Andre? Why is it that you buy at 20? Why is it that you buy December 2026? Why is it that you buy a put? Which put do you buy? How do you combine them? Why is that? But still, if I buy both, I lose my premium. How can I compensate this premium? Oh, I will tell you. I will teach you. These are all questions, okay? I know that this will take, even if you're a clever one, this will take a couple of sessions to understand this whole concept, okay? Now, theory is one thing, but you need to see this also in real life. You need to see this when the markets are moving. Oh, suddenly the stock drops. Hey, what happens with my call? Oh, I compensate with my put. That's what Andre told me. Yes, of course you're going to compensate. So I will show you in real time so that not only you see the concept, the theory, but you also can exercise the theory into practice. Now, I tell you one thing. Don't try this at home, okay? Don't do this. Don't even think about touching it if you have no clue what you're talking about here, okay? Really, do me a favor. I mean, I'm willing to share my ideas. I'm willing to teach you, okay? This is all fine. But please be careful, because you can only lose your money once, okay? So if you're going to do things that you don't understand, don't do it. Okay, if you think this is not for you, I'm all fine. If you think this is too complicated, I'm all fine. If you do have an idea, what I'm telling you is a good solution for your money to protect your wealth, to make this 8% on a yearly basis, then I'm all fine. Okay, I'm willing to help you. Okay, I'm willing to help motivated people. It gives me a good feeling if I share my knowledge. This is what I did tonight. I had 1 hour, 1:30, so we're almost there. But I'm willing to take your questions. I'm willing to share more information, maybe going real life. But this is basically what I'm telling you. So I hope you have an idea why I do it. Why I do it? Because I saw people in the 90s and the 2000s going down with the stock market. They lost 62, they lost 58. Okay, they lost a lot of money and it takes a lot of time. And I don't want that. It's not necessary. If you do it in a clever way, there are other strategies. And I think now, more than ever, after 10, 12 years of bull market, it's time that you realize that there is an alternative to what a lot of people are telling you. This is what I wanted to share with you. And I thank you for your attendance and thank you for your remarks in the meantime. So I give back to Gabi for a moment. And if you have questions, I'm willing to take them. Okay? It's all yours, Gabi.
Thank you, Andre. And this is a moment like it's really interesting where you are presenting. What I notice is our audience are really with you. And on each section, they come out with the questions. Now our chat box is totally full. And
Yeah, I'm sorry for that.
so, and the good thing is actually, even though now it's 9 p.m., but while we are having the knowledge and inspirations, we get very energetic. So, André, what should we do now? Would you like to pick up the?
I mean, I'm fine. I can continue forever. Okay, if you want me to continue for another hour, I'm with you. Okay, I don't mind. Okay, once I'm in, I'm in. Okay.
Awesome.
There's a question. See, Yi-Tsing, if I sorry when I do this pronunciation, there's a lady or a man. I sorry, I don't know. There's a question about the program. Will André be all along coaching at your program? The question is yes, as long as God will. Inshallah, they say in the Arabic world. So yes, I will be all in this program. Okay, we will start and we will finish, and I will be with you. Okay. Okay, Zeng says, okay, I will take some questions, Gabi. Is that okay for now?
Yes, let's go for it. We'll do
Okay.
that very continuous. Yes.
Zeng says, for the put case, insurance just protects you from losing too much, but you still lose money if markets drop. Yes, for sure. That's a choice, okay? Now, if you have the stock and you protect yourself, you will lose if the markets goes down. But Zeng, just think about if you don't have any stock, and what I just told you, if you have the call and the put, in a certain way, you could overcompensate. Or even if you buy a bigger put and a smaller call, you could even profit from a downturn if you want to. So you can but that is for trading purposes. Okay, I will show you. I will teach you how to profit from a drop if you're interested in that. I will. But my first how you say that? The first part that I want to do is to make sure that you not lose money. Okay, the 80%, you need to grow at 8% a year. This is the first thing. Over time you will make money. Okay, I know that you want to be rich and quick and as soon as possible. That's possible, but there's also a huge risk involved. Okay, so you need to make sure that you don't lose your shirt. Okay, you should have to do it in a clever way. Okay, so yes, I'm going to teach you both, but the first most important thing is the defensive portfolio. Let's start with that, and then we go to making more money if markets go down or up. We take on the trading part. Okay. More questions. Is the insurance company also bankrupted? Oh yeah, that's a good one. What if the insurance company also goes bankrupt during the corruption of the market? Well, point is this: if you buy a put, okay, you buy it on a stock exchange. Now, who or what is the stock exchange? The stock exchange exists because there are members. And who are the members? The big banks, like the ING, the Rabobank, the ABN AMRO Bank, all the big banks and all the big brokerage, they are the exchange. So if one of these guys fall down because of bankruptcy, the rest has to pay for it. So if the whole system collapses, that could happen, but then you lose your money in the bank. You will probably have a big problem because all the economy is imploding. Okay, so that you are fine. This the put option you buy, this insurance, is for sure. Okay, as long as the stock market exists, as long as the members, the banks exist, you will be fine. Okay. Regarding the put part, but who will buy it if the company goes bankrupt? Well, no, that's a good point. But you can. That's a good point. If you buy a put, you have the right to exercise. And the right to exercise, somebody else took the other part of this trade. And they are obliged to compensate you because that's the deal. I mean, if your house burns down, who is paying? Well, the insurance company. Why? You pay the premium. So they have the obligation to compensate. And that's the same with the put option. If I buy the put, I have the right to sell. The counterpart has the obligation to buy whatever the price is, whether it's 0 or 10 or 28 or 26. If I exercise my put, and that's definitely what I will do, if I exercise my put, the other one has the obligation to do it. Okay, so that's my counterpart. And the counterpart is not Mr. I don't know who, Mr. Tom. No, it's not Mr. Tom. It's the bank. It's the member where Mr. Tom is banking. Is having his bank account, is having his account. Okay. Well, Yi-Tsing is lost. Tell me, Yi-Tsing, why are you lost? Because I want to help you. Why are you lost? Where is it that you lost me? that I
Yes,
lost you. You
she
lost
was
me.
the- I noticed her message was given while you are talking about the buying the put and the
Yes.
call option in the same time. But
All right. Okay.
yeah.
Yeah. Again, I told you this is maybe to come. Yeah. Okay. One more time. Okay. The put option, if the market goes down, the put option goes up. Just try to understand that. If your value of your house goes down because of fire, the worth of your insurance premium goes up. So if the stock goes down, the put goes up. Okay. Now, that's one part of the equation. The other part was I buy a call. Now, a call goes up if the stock goes up. So if the stock goes up, my call goes up. If the stock goes down, my call will go down, but it is a parachute. It will be not going down as much as my stock. Okay. So on the one hand, if it's going up, I make money with my call, but I lose with my put. If the stock goes down, I will lose with my call, but I will compensate with my put. Okay. It's the combination of the two. This is for now. I hope you understand.
This is a very simple version to summarize it. And
Yeah, it's a simple version. Okay. Then somebody says, why do you use 80-20 and not 50-50? The reason is very simple. Okay. But it's all about you. I mean, I prefer to work 80-20. If you prefer to do 50-50 or 20-80, more trading and less defensive investment, it's all yours. Okay. All I'm telling you is, I know that if you are young and you're in your 30s, 40s, whatever, you have a good job, you make some money, and you want to retire in 20, 25 years, it's very important that a large part of your money is not being lost. You need to protect your wealth. You need to grow at 8%. This is what I'm trying to tell you. If you have 100,000 in 30 years' time, you could be at 1 million. Now, if that's not good enough, then look for somebody else. But if you think, if I have 100,000 and in 30 years' time I can make 1 million by doing a strategy that I protect my wealth, I have a big chance that I can get there. That to me makes sense. Okay, so therefore I say 80% should be focused on a defensive strategy. Now, another thing I have to tell you. Once you understand this strategy, okay, there's no need to watch the screen 24 hours a day to see whether the market is going up or down or whatever. No, you structured your money with a decent strategy. It all takes care of himself. Nothing will happen. If something really happens, okay, you will have this mechanism in your portfolio. Okay, the call will go down, the put will compensate, and at a certain moment, and I will tell you when, in terms of when is it that I should reposition myself, you have to reposition. Okay, you have to take a loss, you have to take the profit, and then you get out and you start again with a new deal. Okay, this is the idea.
Yes,
if you make a lot of money in September, I get out of my hold. I will sell my call. I will sell my put for remaining premium, and I will start a new deal. This is the idea how I do it. Okay, and I will tell you when to get in, when to get out, how to do it, how to reposition yourself, etc., etc. This is all part of the strategy, of course. Okay?
Yes. So in this case, like so Andrew, I also noticed like like Milan, and later after this event, I also have 2 calls scheduled for the students who are interested with our coaching program. So Milan, she's asking that she would like to know more details about our 1-year coaching structure.
Yes.
Yes. Yeah. Should we go to our landing page or just like a show?
Yeah, well, let me show you, because if I'm talking about what can you expect, I can only tell you what I did over the last 10 years, okay, with this defensive strategy. So I show you the results that I was able to achieve in our program, okay? Now, as you can see, it could also be a little minus or literally almost nothing. It could also be 14% or 16% or whatever, okay? I cannot promise you the fixed 8%. Okay, it all depends on my judgment, on the strategy, on how I see the market, etc., etc. But I will guide you. I will guide you with this strategy. But one thing is for sure: you will never see a minus of 50% here. Okay, I hope you understand that. So this is what we did in our defensive portfolio. Now we also run the trading portfolio, and the trading portfolio is a bit more offensive. Now, funny enough, somebody told me, he said, Andre, listen, last year you made 16% on your offensive portfolio, and in your defensive, you made 19. How come? Yeah, that can happen. Okay. The trading was a bit more difficult last year. I found it more difficult last year than a lot of years before. Okay. So, yeah, and sometimes you have a big hit like 40. That was really a bit above average, as I would call it. But sometimes you also have a below average. Okay, so both the ideas, I will run again my portfolio. I will show you the strategies. So this is included in the program. And also included in the program is that I have updates. Okay, and every move I make. So first of all, I'll teach you the strategy. Okay, the ins and outs of the strategy. That will take a bit of time. I think we took 2 days, something like that, in online sessions, more or less. So we do an online session. Maybe we do a one-on-one session. How you say that? A physical session, if it's possible again. But that we can see. But anyway, I want to teach you the theory. That's very important. You have to understand what we're doing. Then we start, and I will show you trades and strategies. Okay, and I will follow up on them. So if I make a move and I say, okay, now I'm going to do this. Now I'm going to do that. This is the reason why. And then you should grow into this strategy. You will see it working in real time. This is very important to understand. Okay, so and then if you understand enough, then it's about time to follow up. Okay, so try to be realistic. Okay, I cannot promise you anything. This is just an indication. Okay, all I'm telling you is I thought about the strategy. I know what the good things are. I know what the risks are, because there are risks in every strategy. Also in this strategy, there's risk. Risk, what kind of risk? You can lose premium if nothing happens. So if nothing happens, you lose premium here and you lose premium there. So you have to compensate that. And I will tell you how to do that as well. Okay, so that we have a big chance to make money. Not the biggest money, but a good chance to make money. This is my philosophy, what I'm trying to tell you. Okay, and so whether you have a lot of money to spend or smaller money, I don't care. For me, everybody is equal. Okay, my father had a grocery shop. I'm very simple from nature. Straight is straight. So I'm willing to help. Okay, if you have the motivation, I'm willing to help. If you have no motivation, please stay out of my way. Okay, because I'm not willing to spend any energy on people who have no motivation. Okay, do something else. Go to the bank, let them manage your money, and be happy for the rest of your life, I hope. Okay. So if you have the motivation, I'm willing to help you. What was it that I was trying to tell you, to show you about the program? Yeah, I had so much things that I wanted to share with you about Baidu. I have a strategy. Here's my strategy in Baidu. This is actually a position I have on right now. Okay, I told you in the beginning, I like Baidu. Okay, why? Now, very simple. It went up to $350 last year. In February last year, the stock was at 350. Incredible. I didn't touch it. I missed it, by the way, because I was not focusing on this stock. But then it came down and down and down. And I read about China. I read about these companies. And I saw what the Googles were doing. And I thought, this is crazy. The Googles came more expensive. And the Baidus went down. Now, 2 or 3 years ago, I did a trade in Baidu. That was okay. So I said, okay, maybe I take another look. Now, recently, I saw the stock, and hopefully I have the chart here. Now, let me see if I have the chart here. Yeah, this is a chart. Oh, I can explain to you why. Now, this is a chart of Baidu. Now, take a look. This was going on. I have to see because it's a bit dark. This was 2021. This was the top, the 350. Now it went down. And now what I see in my chart, and I learn I will teach you how to read these charts, because it's very important. The timing, of course, is another aspect of trading, but also for investing. Now, what I see here is that there is some support in the market around 135, I guess it is this level. Now, I see it bouncing on this support, and I believe that this whole run-up is 100% compensated now to the downside. So I believe this is definitely a good moment to step in, okay? I think it should be possible for this stock to go up anywhere around the 180s, okay, over the next couple of months. So I think there is potential there. Now, I want to go in with a smart way. I want to buy my call. I want to buy my put. I want to protect myself if I'm wrong. If the support is broken, you can see a severe break. It could all happen. Okay, I never know for sure. So I protect myself. So I step in. Now I will tell you the position, but the result is this sheet. So this is my heat map. So it tells me what I'm in. So right now I step in 150. I stepped in at, I think, something like 140, 145. Okay, we are currently trading, by the way. Today we are up 152.68. So we are anywhere here in this area here. Now, this is January, and I have a position running for the next year. Now, if I'm right, and the Baidu is going up in this area, 180, 185, I am trying to get around, let's say, $4,000, something like that. I think this is the amount. Okay, based on an investment, of receiving $900. So it's a bit complicated, but so it's a huge return, and it's a nice profit, and I will make 20% of my money. Okay, so that is 20%, 19%. This is if I'm right at 185 in the next months. So you can see that if I'm right in February, I already make 26. Okay. If I'm right in next year, then the maximum is this 44K. Okay. So what you see now, what's happened. Now, if we go back to 250, I don't expect that, but anything can happen, as you know. So if we go back to 250, that would mean that I can make a 61% return. That's fine. But what if we go down to, let's say, 135, for instance, the last support level? That would mean that I will lose 12%. Now, if I go down to 100, what would that mean? Then it would mean, in this case, I would lose 35%. So it's still possible that I lose. By the way, this is a trade. This is not a defensive 80% portfolio strategy. This is a higher risk, okay? Higher return, higher risk, to be fair in this one. Now, my risk here is anywhere between, let's say, 10 and 35%, okay? But my upside is anywhere between 0 and 60%. Now, the point is this. I have an asymmetrical risk-return profile. And this is what I'm looking for. So I don't step in and say, oh, great company, I buy the stock and let's see what's happening. No, I want to go in clever. I want to see, okay, how can I make money on an investment like about 1,000 euros? I try to make 4,000. That's incredible return, right? So with leverage, this is a great return, but there's still a lot of risk involved. So this I won't play with 80% of my money. This I will play with 20% of my money, okay? So basically what you need for this is, first of all, understand where we are, looking for timing, looking for a moment, looking for the moment to step in. So this is something I'm going to teach you, how to read these charts. Then the strategy itself. So what is it that I do? You see calls and puts, you see them here. So I will show you how this strategy looks like. So I will buy a call, a longer term call. I will buy, in this case, a put. You remember that one? I buy a call, I buy a put, but that's not the only thing I'm doing. So this is step number 1. This is step number 2. And then I will teach you how to sell options in a certain way. So that in the end, what I invest is even something like $900, okay? $900. And what I can make is 4,000, okay? So this is a trade. There's nothing to do with the defensive portfolio. Okay, so so this is something I can show you and I can teach you, and then you can see that in a graph. You can see how it goes. What is it that I will probably earn on the 1st of June? What my strategy will be in August or in September? You can all make a simulation. Okay, when is it that I'm going to make money? How much money? And how does that relate to the risk that we have? And how much risk are we willing to take? Okay, I can get out earlier, right? I don't need to lose 20% if I don't want on the money. But there has to be a decent risk, but a bigger return. This is what I'm looking for. Okay. And again, yeah, I wish I could do this in an hour time, but that's impossible. Okay.
Indeed, actually, like I think up to now is you really giving us a lot of very enriched and also quite updated like information about this current market. And but of course, like it's we cannot develop any of our like own investment strategy, because while you were sharing about like, okay, if the market goes down, what do you do? It's actually putting me back with my history. I was in the real estate, in the cryptocurrency, in the stocks. And when everything goes good, I buy more. But when the market goes down, and what I did is just cross the finger and wish my good luck, and the market will go back. And every time when the
buy
market
and hope strategy. And
buy and
sometimes it
hope
will be, and sometimes will be buy and pray.
yeah. And like when the market goes back, I immediately withdraw my money and I stopped. So therefore, I think as for the, I believe everyone who comes to join us tonight, and we really have the motivation, like this is what you said, that is a key foundation.
Yeah.
And but the important thing is we need to have the environment, we need to have the coach, and we need to have the structure, and we need to have the information. So therefore, I think this is all included with our 1 year trading course program. So Andrew, do you think you can quickly show us like how the system look like where you upload all those 3 or 4 days the market trend, the videos? So
maybe Tom can show you a bit. Let me tell you one more thing, because you're talking about real estate, and I know a lot of people buy real estate. Okay.
Yeah.
I think in general, real estate is fine. But there's one important difference between real estate and the stock market. Can you buy a put to protect for downturn in real estate? No. Can you sell out at any moment and every second? If you say, I want to sell, are you sure that you can sell it? Yes, if the market goes up, you can sell it in a moment. But if the market goes down, you have to wait for a buyer to turn up. In the financial markets, if I want to step out of this strategy, I just press a button and I'm out right away. Okay? This is a big advantage. If I want to protect myself, I can, because these instruments are there. This to me is the most important thing. Okay? So again, this is what I learned from how people behave in financial markets, from what I saw. So this is why I changed the whole philosophy, and I tried to explain to you why. And so this, I believe, is very important. Okay. Indeed. So anyway, anyone who is interested to find out more what the program looks like, what's included and what's not, what are the costs, blah, 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 please let them type in their names and we will stay in touch. Tom or you, Gabi, will contact them. We can explain about the program. And it's a 1-year program, theory and practice mixed. And I will guide you through the next year. So whatever you need.
I think it's good to sum up some things we will do in this course.
Yes.
So people will get a 2-day introduction course, 2 private coaching sessions with you. Every month, video updates about the current positions. They get access to our education portal. They get updates through our website, email, and WhatsApp. Access to all our courses. Access to, of course, a group that are like-minded people. Access to unique content, just special for the group who's following this program, and they can use us to ask questions and everything they want.
Well, I started to smile if you watch me. Thank you, Tom, for giving. By the way, Tom is my son, as you can mention from the last name, and he's taking care of all the technical things, but also about the company and the program. I'm more from the content, and Tom is taking care of the rest, which is great, working together as father and son. So what Tom just said is an overview of what we have to offer. What is interesting here is I saw Dan, he is reacting, and he says, yeah, great, I would like to be on part, but is there an early bird discount? Now, this to me sounds like a Dutch guy asking for a discount. So I hoped that we have these serious investors from China saying, okay, if it's good, I pay the price. I'm not going to trade. But you see, you are great traders already. You're asking for discounts here, okay? So option deal, Vivian says, yeah, great. You have to judge by yourself, okay? I think we're worth it, but you have to judge for yourself. And of course, it's maybe difficult to judge after this evening, but I hope you had an idea. And again, we are more than willing to give you more information. And I think this is investing for the next year, and hopefully you will have profit for the rest of your life. This is what I really believe in. So, okay, this is what we had to share with you. Anything else will be taken care of by Tom and by Gabi, I guess. And hopefully I see you in the beginning of of the 1st of April when we start this program. Okay, make sure you reserve your place. So full is full, and let me know whatever is going on. Call me Dutch now, but will this course get a tax refund from the Belastingdienst?
Yes. If you put it in your company, yes, you will get a tax refund.
I like that. That's what I like.
Yeah, so I want to ask you, it's a training. Yes, it's a training course of a year.
It's training. It's a coaching program. It's a training program. We can match that. Yeah.
And we will give you access to a special portal where you can follow the portfolio of André, where he do his positions explanation, and you can do it yourself if you would like to.
Yeah. Okay. Good. That's it, I guess.
Yeah, maybe maybe Gabby and I can stay a little bit for some questions. And,
that's good. I mean, I'm fine. I'm still here.
I don't know if there's still questions, but
yeah. Okay. All right. Okay, but the official program, I think we can round it up right now. And if there's any more questions, just get in touch with us and we can explain to you. Okay?
Yes.
Okay.
Right. Oh yeah, by the way, one more question here. I see it coming up. Also a good one. If I miss a session, will there be a next training program April 1st next year? I cannot promise. Okay. Really, I don't know. This is the first international one because I'm used to speaking Dutch and not so much in English. So sometimes I have to look for words, but hopefully by practice I will improve myself. But if you miss a certain session, everything will be recorded. So don't worry if you have certain sessions that you will miss. That might happen in a year's time, but everything will be recorded, so you can look it up anyway. Okay.
Right.
Have a great evening. Thank you very much, all of you, and I hope to see you. And Gabi, again, thank you very much for introducing us to the audience. And Tom, thank you very much for your help. And see you next time. Bye-bye.
Thank you all. Yeah. And just, for some of you who have some specific question about this course, you can either remain a little bit longer with us, or you can just end me via the WeChat. I already leave my WeChat account on the message. And, just feel free to call us too. Yeah. By the way, Tom, do you think we can unmute some guests, or they can only type?
Yeah, we can. We would like to unmute.
Yeah, so this is a question from Danny. Yeah, so in short, so Danny, for the entire 1 year, the course, there are in total five live sessions. So really, we will let you know ahead about the specific date of the live sessions. And each live sessions will last from 6 hours. The first one, the day one, will last for 6 hours. And then every season, we have, on Saturday morning, we have 2 to 3 hours of live sessions. So this is about, live sessions. And
and he's also asking for private sessions. How long? The private session will be 1 hour. So you have 2 times an hour with André to discuss your personal needs or questions.
Yes, and reading like this, the purpose of the private sessions reading for come out reading tailor-made. What is the investment strategy really matches for you? And by the way, Danny, I'm not sure we have each other. We are the the WeChat. Maybe we can end each other there. And by the way, Tom, I also need to, I have another call. It's another student who is interested to join, to register. I need to call her, yes.
Okay, no problem. I don't know if there's any question we can still discuss, or otherwise we end this session. And if you have any further questions.
Quite many students still waiting online. I noticed actually Danny, I don't have her yet. Vivian is asking how much is the fee. So Vivian, there are the total tuition before tax is 2,995. So if you have a company and we will end 21% of the VAT tax, and with a company you can get tax refund. And there are 2 types of payment. One is like a one-time payment, 2,995. Another one is you can pay the first season. It's about like 700 something for pay for the first quarter. Maybe Tom, we can put the registration link.
Yeah.
Gotcha. Yes. Thank you, Vivian. I also don't think I have you via my WeChat yet, Vivian. Yes. So Mina, well, I have you on WeChat. I will send you the brochure about this course.
Or fill in the summary we can send you by mail.
Yeah. By the way, Tom, actually for our audience, they are able to unmute themselves, right?
No, they can't unmute themselves.
Okay. Same with you. Have a nice evening and a good rest.
Yes.
And
thank you. Have a nice evening. Thanks for joining.
And before we notice that we're already like 30 minutes past than our scheduled time.
And no problem.
Yeah, but indeed, I think it's a good crowd. They come with good questions. Does course covers application of option spread strategy in practical? Is
Yes.
Johnny still here? Yes. Right.
Yes. Yes. We will have an advanced option course.
Yeah.
It's recording in Dutch, but will be available for everyone who's joining the program. But we will also include during the year, we will build up the option information and strategies. So we start a bit simple and we build up to really advanced level.
Awesome. Yes. So maybe Tom, we can quickly go through with all the chat messages. And for some audience, right, who might already left, but they are interested with the course, I can do some follow up. By the way, Tom, for tonight's the record sessions, and we will like divide them into the multiple videos, right?
Yep.
Awesome. I think Tom, for now should be okay. It's already nice. I also want you to have some rest, and for our guest, I will do the follow up with them. Yeah, we're reading the group. Yeah.
Okay. Thanks everyone who's still there, and hope to see you in April with the start of the program.
Yes. And by the way, yes, Johnny, I spoke with him already, and he's himself is also very professional in investment. And so maybe like, if some question I can answer, maybe I will engage you for some private call. Yeah,
they can call me.
Awesome.
Okay.
Thank you.
Thank you.
Night.
Thank you very much. Bye-bye.
Good night. Have a good rest. Bye-bye.
Bye-bye.
Bye-bye.